No summer break for fighting in Ukraine and the Middle East. Changes at the top of Japan, Thailand, and Starbucks. And the U.S. government mulls breaking up Google. This is Bloomberg Wall Street Week. I'm David Weston. This week, Greg Peters of PGIM on how bond ETFs are transforming the fixed income market.
So I think the growth is just beginning.
Zach Liscow of Yale on the hurdles facing the Biden administration's race to build infrastructure.
The U.S. just has a long-standing difficulty building infrastructure.
And Jon Klein of Hang Media on why legacy media companies are having so much trouble.
It's a problem with the industry that they find themselves in.
We start with the U.S. CPI numbers out this week and welcome Jan Hatzius, Goldman Sachs chief economist, to take us through what they tell us about the economy. So welcome. It's great to have you here, Jan. What did we learn this week about the U.S. economy?
It's great to be here. I think the information we've gotten this week has been very encouraging. On the growth side, mostly good news, another drop in jobless claims, and a clearly stronger than expected retail sales number. That was very reassuring in light of the weaker employment report for July and the concerns around the consumer at the bottom-up level in some of the earnings reports. In the macro data, we're not seeing the consumer softening sharply. And I think that's the probably number one takeaway as far as economic activity is concerned. There were also some more mixed numbers from industrial production and housing starts, but I would put more weight on the consumption news than on those.
We also are down to a 2 number, starting with the 2 at least number on the headline CPI. So are we getting inflation under control? Is it going to continue in your opinion?
I am very optimistic that inflation is largely in the rearview mirror. If we look at the July core PCE estimate that we get on the basis of CPI, PPI, and import prices, we are at 13 basis points, which is yet another sign that we're on our way back to 2%. Now, in terms of year-on-year rates for core PCE inflation, it's going to be difficult to make a lot of headway in the second half of the year because the year-on-year comparisons are becoming more difficult. We had very low sequential inflation rates in 2023, but I think on a 3-month annualized basis, a lot of the underlying trend measures are saying we're pretty close to 2%, and this is no longer a major issue for monetary policy.
As is always the case, there are some ups and downs. Some things are a little better, things are a little worse under the headline numbers. But what about housing? Does that give you any pause with respect to how much control we're getting over inflation?
Well, I think the rent numbers were a little higher than expected in the most recent release. But if I look at the trend in rent, we are seeing a deceleration in rent, in owner's equivalent rent. There are some alternative indicators from the Cleveland Fed and the Labor Department that break down rents into new leases and existing leases. Those are showing a clear trend towards improvement. And I think just based on our modeling of how new lease prices translate into the overall CPI numbers, there is a very high confidence that we'll see ongoing gradual improvement. The other point I'd make on inflation is what are we seeing on the labor market? We've seen the labor market rebalance. The unemployment rate has drifted up to 4.3%. We've seen very large declines in job openings and quits. We've seen a very material deceleration in wage growth. The latest average hourly earnings number was only 3.6%, and that basically says we no longer have a significant labor cost issue. Unit labor costs were up only 0.5% on a year-on-year basis in the second quarter. So all of that is very encouraging.
Where are you right now on the possibility of recession? When we started the year, a lot of economists were really almost predicting recession. Larry Summers, for example, in this program was saying it's more than 50% likely. That's changed over the course of the year. Where are you on that right now?
So we've been we were at 15% coming into the year. We lifted that from 15 to 25% on a 12-month forward basis after the employment numbers for July. Not only because of the employment numbers, we also had seen a couple of higher initial jobless claims numbers. We'd seen some weak survey evidence. We'd had some negative anecdotal information about the economy and the consumer in some of the earnings reports. So we lifted it somewhat, but I'd say 25 basis points is still, of course, well below 50. It's still somewhat below the consensus. I'd say at the margin, what we've seen over the last 2 weeks has been encouraging. So I think the likelihood is that 25% is going to come down again. I would like to see a little bit more information, especially, again, the next employment report, just given the predictive value that we've seen historically from labor market information for recession that's encapsulated in the so-called SAM rule, that if you see a 0.5 percentage point increase on a year-on-year basis in the unemployment rate, historically that's been a very strong recession predictor. I think there are some good reasons why that rule may not hold and probably doesn't hold in the current environment. In particular, the fact that we've seen a very large increase in the labor force, very large increase in immigration, and that's really, in our view, the main reason for why we've seen a higher unemployment rate. Employment is still growing at a good pace, despite this latest somewhat softer number. Overall, still seeing very strong employment growth, and so it just seems like a different type of increase in the unemployment rate that's probably not as predictive of recession. But it's hard to be sure, and that's why we are, hedging a little bit more.
We had some important economic data out this week. Next week, we have the meetings in Jackson Hole, where a lot of central bankers, including Jay Powell, the Fed chair, will be gathering. What do you expect to come out? What are you anticipating? What are you looking for in those meetings?
Well, I'm certainly expecting a signal that the next move in interest rates is down and is close. That was already clear at the most recent press conference when the Fed, decided to stay on hold. We actually thought that there was already a strong case to cut at that meeting, but they decided to stay on hold and signaled, pretty clearly that a rate cut is on the table for the September meeting. The news that's come in the meantime, in particular the employment numbers, I think cements that. That will be visible in Chair Powell's remarks. He's not going to give us details. I don't think we're going to learn, for example, whether it's going to be 25 or 50. But I think there will be a recognition that inflation has come down very substantially, that we're on our way to 2%, that the committee is more confident of that, and that will set the stage for a normalization of the monetary policy stance. I think there could be a discussion of, labor market softening, and maybe you could talk about the distinction between benign labor market softening and more concerning labor market softening. Perhaps talk about some of the issues around immigration and in particular labor force growth. It's very difficult to know what he will choose to emphasize, but I think those would be some very sensible topics to address.
Jan, it's such a treat to have you on Wall Street Week. Thank you for being here. That is Jan Hatzius of Goldman Sachs. Coming up, we go through the market reaction to the events of the week with Kristen Bitterly of Citi. That's next on Wall Street Week on Bloomberg. This is Wall Street Week. I'm David Weston. The market continued its rebound with the S&P 500 having its best week of the year, adding 3.9% to end the week at 55.54, putting it just under the median number the Bloomberg Elves have projected for the end of the year. The Nasdaq did even better, adding 5.29% on the week, while the yield on the 10-year was down 6 basis points to end the week at 3.88%. To take us through the week in the markets, we welcome back now Kristen Bitterly, Citi Head of Wealth at Work. So welcome back. Great to have you always here, Chris. So give us your sense about what happened. We've been through a wild ride over the last 2 weeks. And take us inside Citi. How did your shop react when all of us were running around saying, oh, emergency rate cut?
Sure, of course. I think what's interesting is at Citi Wealth, we've actually been pretty resolute in terms of our views this year. We started out this year thinking that we would get 3 interest rate cuts of about 25 basis points and that those cuts would not begin until the second half of the year. And so even though we've seen this wild repricing of rates throughout the course of the past couple of months, and we could even say year to date, we just thought that the Fed would not get the data that they needed to confidently start cutting rates. And so what happened last week was pretty wild because I think the market once again got ahead of itself in terms of, is there going to be an emergency cut? Are we locking in a 50 basis point cut? I think we're still at 25 basis points because of this economic data that we're seeing. We'll get a good piece of economic data, and then we'll get one that maybe is a little concerning. Take today, for example. We have the consumer sentiment data that came out better than expected, and then we had the data around construction that was worse than expected. So I think we're going to see this volatility in the data, but the good news is that inflation is on the trajectory that the Fed needs, and that the labor, when you look at the labor market, it's cooling, not contracting, and I think that's a sweet spot in terms of the Fed's position to be able to start cutting.
Where are we on earnings? Because that drives an awful lot of stock prices.
And that was another reason why last week, so just take like August 3rd, for example, that really horrible day in the market where, you know, if you got out on that date, you would have actually missed out on a pretty substantial rally of about 7% in the S&P 500 since then. But the reason for it is earnings have actually been really resilient. If we go back to last year we had about 7 out of the 11 sectors in the S&P 500 that were experiencing an earnings recession. This year, we actually expect 10 out of those 11 sectors at Citi to turn to earnings profitability. So earnings have actually surprised, and what we're seeing is really a broadening out of that story. It is no longer uniquely a Magnificent Seven story. We're starting to see it come through in earnings across various sectors, which is actually a reason to stay invested.
Well, so I'm going to ask exactly, how many people are fully invested still at this point? Because as you point out, if on August 3rd you'd gone to cash, you'd be sad right now. To what extent is there still cash on the sidelines? I
think there's still significant cash on the sidelines. You could look to money market funds and the flows that have come into money market funds as an example of that. So the latest numbers that I saw were about $6.3 trillion in money market funds, and that doesn't include cash held in deposit accounts and other types of bank products. So when we think of other catalysts for the market, just think about this. If we do start to experience interest rate cuts, what's going to happen is all of that cash that is no longer receiving a 5% plus interest rate is going to look for places to reinvest, and it's going to be a balance across equity markets and fixed income markets.
So overall, it sounds like you're pretty constructive on the markets. Pick some spots for us. Where does it make sense to have more of investment rather than less?
So I would say there's kind of 3 key spots where we've been spending a lot of time. The first, and this is really over the past couple of months, the first is looking at the S&P 500 equal weighted exposure as opposed to the market capitalization weighted exposure. That's, again, playing this broadening out theme, but having diversification across various sectors, and also with an acknowledgement that many people already have exposure in passive investments to the market capitalization weighted index. The second area would be looking at just kind of size, looking at mid cap and small cap. Not going into the Russell 2000 necessarily, but looking at profitable areas of those segments of the market. And if you take a look at mid-cap, for example, 20% of that index is really represented by industrials, which are a really good proxy play for the broader Gen AI play that everyone wants to be invested in, but it's doing so through infrastructure. It's doing so through investing in the energy grid in terms of that energy consumption. And the last piece that I will say is it always makes sense to play the long game. So via what we call our long-term unstoppable trends, one of them is investing in longevity. And that is something that, regardless of the market cycle that we're in, we think it makes sense to have capital invested.
Longevity, including healthcare.
Absolutely, absolutely. And it's really two different sides of that coin, because longevity is playing really the fact that we're living longer.
Yeah.
So I think you have to analyze that. How is my portfolio working for me? And how do I think about investing capital for what now is a longer lifespan? But then on the flip side, when we look at what really is dominated, which was GLP-1 drugs, and then life sciences, medical equipment have been left behind. And these areas that really blend technology with that underlying development, I think is going to continue to attract capital.
Chris, I don't want to let you go before we talk about your new position. Since we've seen you last, you have
thank
a new
you.
position. Congratulations.
Thank you so much.
Tell us what it is. How is it different?
Yeah, so I'm running our Wealth at Work business globally for Citi. And what that is it's really workplace wealth solutions. This started with an area of our business that we've actually been dominating and had for over 5 decades, which is our law firm group. So where we bank entry-level associates through to senior partners and institutional capital. And what's unique about it is it really brings the perspective of not only knowing you personally in terms of your wealth journey, but also looking through how is your industry impacted by various trends. So it's knowing your business and how to advise you professionally, but also personally. And we've expanded that on a global basis, but also looking at other segments like asset managers, professional services, and just other segments of and sectors of different types of companies. So really exciting, but thanks for asking about
You're
it.
preaching to the choir. We like lawyers here at Wall Street Week, I'll tell you. Thank you so much, Chris. Great to have you with us.
Thank you.
This is Kristen Bitterly of Citi. Coming up, the Biden administration is proud of the over $1 trillion in infrastructure it got enacted. We go through how long it will take before we see the results with Zachary Liscow of the Yale Law School.
If you look at government spending on research and development, we are behind peer countries and we're behind where we used to be.
That's next on Wall Street Week on Bloomberg. This is Wall Street Week. I'm David Weston. The Biden administration prides itself on the investment it's making in clean energy and semiconductors. But it is having a little bit of trouble getting the money out the door. And one of the biggest beneficiaries, that's Intel, has announced large job cuts and the need to protect its cash pile. Yale law professor Zach Liscow, former chief economist at the OMB, has studied infrastructure investment and challenges in making it work. And we welcome him now to Wall Street Week. So, Professor, thank you so much for being here. It's great to have you here. You have studied the question of, it's a good thing to have the intention of getting infrastructure investments made. It's a little harder to get it done, at least in the United States of America. What are some of the impediments to that the Biden administration may be facing right now?
Yeah, great question. And a pleasure to be here. So first, I want to say a little bit on what we see on the ground now. So if you're talking about manufacturing, things actually look really good. What we're seeing is investment in manufacturing, building structures. The current levels of that are roughly double what they were from the period between 2000 and 2019. So we are just blowing out of the water the amount of investment that we're making in manufacturing. This is in real terms, adjusting for inflation. So a lot is getting built in terms of manufacturing. But there are different kinds of investment. We also are making a big push in infrastructure, and in particular, things like transportation. And this is not because of this particular administration, but the U.S. just has a long-standing difficulty in building infrastructure, transportation infrastructure, in cost-effective ways. If you look at urban rail, so within a city, and it's on a rail, and you compare the U.S. to other high, medium-income countries, on a per-mile basis, the U.S. spends about 2.5 times as much per mile. You compare it to the lowest-cost countries in Europe, countries like Spain, we spend about 6 times as much per mile. And, this is not good.
Zach, as someone who's studied this, as an economist as well as a lawyer, really studied the question of infrastructure. Let's go back to where you started. Is there a big difference between sort of the true public infrastructure, if I can talk it that way, highways, rails, water, electrical grid, and things like that, on the one hand, and on the other hand, some things that the government may get involved in, at least in subsidizing and really encouraging, but that also private corporations do? I mean, when you talk about building semiconductors, that's something typically in the United States we let private companies do. Is there a different way to approach those two questions?
Yeah. Roads are public goods. Makes a lot of sense for the government to be in charge of building them. It would be very problematic if a private company on the road in front of my street and were like holding me each time I wanted to enter my house. That would be a bad way of running things. So it makes a lot of sense to have the government own the roads, own the highways, and then to subcontract out to the private sector to actually have them built. There's a whole different thing going on with manufacturing. We do not want the government to be the one, actually building these semiconductors. We want the private sector to be doing that. Those are not public goods. Those are goods that are exchanged in competitive markets. And for those, we have, in the case of chips, say a national security reason to onshore those, and thus to provide government subsidies to provide them. There are climate reasons to provide subsidies to bring about the green economy in terms of energy production. And so I think it's good to take these two different approaches. For transportation infrastructure, government designs it and manages it, and then to have subsidies for these other private sector things, which are often in manufacturing.
And finally, we tend to focus on the big projects that we can see, we can touch, we can feel, we can use. What about basic research? Because if you go back in time, as I understand it, a lot of the benefits we have today came from basic research done in the 50s and 60s. And I believe it's the case that during the Eisenhower administration, as a percentage of the federal budget, basic research went up. And since then, it's been going down. How much are we underinvesting in basic research that then we can allow private industry to exploit?
So, great question. If you look at total research and development in the economy, we're doing okay. The U.S. is doing okay relative to peer countries. But like you point out, if you look at government spending on research and development, we are behind peer countries, and we're behind where we used to be. So our private sector in the United States is very innovative. They're doing research and development, but the government is not doing as much as it used to. There's a whole field of economics. There's a lot of evidence. Government research and development into basic science is extremely beneficial. It pays for itself multiple times over. And the logic is actually very similar to the roads. Roads are used by the public more generally. If the government doesn't provide them, they're probably not going to be provided very well. Same thing with basic research. If the government doesn't provide it, we're often not going to have enough of it. So my read of the research is it would be very beneficial to fund more of it. The CHIPS and Science Act authorized increased spending. That has not all been appropriated by Congress, though, and I'm very hopeful, or I really hope that future Congresses increase spending on basic science, including the funding authorized in the CHIPS Act.
Many thanks to Zach Liscow of the Yale Law School. Professor Liscow's paper for the Aspen Economic Strategy Group will be out this fall. Coming up, what started out as a small novelty has evolved into a $2 trillion asset class. We go through how bond ETFs are remaking the entire fixed income market with Greg Peters of PGIM.
If you talk to some of the real ETF advocates, the sky's the limit.
That's next on Wall Street Week on Bloomberg. This is Wall Street Week. I'm David Weston. Barclays launched the first ever bond ETF in Canada back in 2000. And what started out as a novelty has grown to be an over $2 trillion asset class, changing the entire market. To take us through fixed income ETFs and why they've grown so big, we welcome now Greg Peters, Co-CIO of PGIM Fixed Income. Greg, great to have you back with us. Thanks for being here.
Thanks for having me, David.
So take us into this world of bond ETFs. A lot of us think about it in terms of stocks, but it's going to be quite a substantial part of the market.
It is, and I think it's poised to grow even more. As we talked about earlier, the global fixed income market is $120 trillion, and so $2 trillion seems like a drop in the ocean. So I think the growth is just beginning. But I think the important aspect of ETFs for bond investors is that it's changed how the market trades. And it's created more liquidity in the marketplace. And post-GFC, it's allowed to bond investors, I guess, to re-liquefy in ways that they didn't imagine prior to.
So why has it grown so big? And you mentioned the great financial crisis there. Is that part of the cause in the sense that there was a lot of regulations that came in after that that really made it a little harder for some of the dealers to keep big balance sheets? That's
precisely right. The dealer balance sheets were really constrained post-GFC through the alphabet soup of different kind of regulations, and it really hurt the end investor because you as a fixed income manager have to go through the dealer in order to transact. The ETF platform, I call it the chassis, the infrastructure, allows through the redeem and create process trading of individual bonds in ways that were unimaginable before. And so this revolutionary, evolutionary type of process has really allowed fixed income to re-liquefy and trade much better.
You mentioned one of the effects is increased liquidity. Back during the pandemic, March of 2020, we had some problems with liquidity. Do the bond ETFs hold out at least the possibility that they will be able to take us through some of those rough patches?
I hope so. One event doesn't, make a declarative statement, of course, but it was really interesting. Back in March of 2020, voice trading effectively shut down. And what you saw was through ETFs and electronic trading, which is still only about 45% in the entire fixed income universe, traded at levels that we haven't seen before. So we had record levels of volumes at a time when it was really difficult, almost impossible to transact elsewhere. So I think that is a testament, of course, but each crisis is a little different. You just don't know, but I think the early signs are actually quite positive.
You mentioned voice trading versus electronic trading, which is one of the advents here. As I understand it, stocks are more likely to be traded electronically rather than through voice. Why is the fixed income market behind in that? Is that just a matter of timing, or are there some inherent differences in bonds, in part because there are so many different kinds of them, but that really keep you from doing more electronic transfer with bonds?
I think it's a little bit of both. I think historically the fixed income market has been known late adopters. Also at the same time, as you mentioned, unlike a single stock, you have multiple bonds off a name. So use IBM as an example. There's only one equity security to trade, but you could have anywhere from 50 to almost 100 different CUSIPs of IBM. So it's just, the complexity is just much more difficult. And the market is much more segmented as well. So I just think it's about time, because if you think about complexity, that's where computers and machinery and algorithms can really add a lot of value. It's just been slow to adopt.
Who are the most likely customers for the ETFs? You say you think they're going to keep growing the bond ETFs, but who are the people that are target customers for it?
Yeah, so what's interesting about the bond ETF market is that if you look at, particularly relative to the equity side, it's institutional bond managers like myself and ourselves at PGIM that actually utilize that security. So it's a much more of an institutional vehicle on the fixed income side, whereas on the equity side it's much more retail driven. So we'll see how that changes over time. But the way that active money managers like ourselves think about these passive ETFs, it's a way of kind of modulating your liquidity, modulating your portfolio risk in a more seamless, efficient manner. So that's why it's taken off.
As a big manager of fixed income here at PGIM, do you tend to trade in individual bonds, or is this in whole portfolios that move at the same time?
It's both. So you tie ETFs, that infrastructure, to what you're seeing through electronic trading, namely portfolio trading, which is not a CUSIP-driven trade, it's a characteristic-driven trade. And so you now can trade, up to 100 some odd names in packaged form and get liquidity. Whereas before, David, you had to kind of on the phone call individual and trade lot by lot, and that was just grossly inefficient and really difficult to prosecute. So the packaging has been the key risk transfer piece to it all.
Well, we said it's gone from, what, a couple $100 million up to $2 trillion now. How big can it get? Where's the sky here that it could grow to?
That's an excellent question. I'm not sure if you talk to some of the real ETF advocates, the sky's the limit, of course. But I think there's real scope for it to grow and to continue to grow. The issue around fixed income is the fragmentation of fixed income, right? So we talked about 120 trillion globally. You have various government securities, you have corporates, you have high yield, you have levered loans, you have all these different products. You have privates as well. And so it's not homogenous, right? And so I think it makes it much more difficult to kind of finally put a number on it. But I still think growth is upon us.
You mentioned privates, which has been a big growth area in your business at private credit. Are they involved in the bond ETFs, and is there a possibility for more privates to be involved?
There is that talk, there is that race towards taking private credit, which doesn't get marked and has no liquidity, into an ETF. Quite frankly, I'm not sure how that will work, but some institutions are desperately trying to put that forward. So it'll be really interesting to watch. But the interesting aspect about how ETFs are being used is somewhat kind of alchemy in a way, right? So you take illiquid or less liquid securities and package it and turn it into a more liquid product. So the question on the table ultimately, David, is will taking a package of private loans or bonds with virtually no liquidity and turn it into a vehicle that has some liquidity? We'll see how that plays out.
In life, at least I like to say, there's no such thing as a free lunch. So this is more liquidity, new innovation, more electronics. What are the risks in this growth in bond ETFs as you see it? Are there risks out there we should be at least thinking about?
I think there's always risks. I think the one risk that I think about is, do you have such an over-reliance upon this one aspect? So if you think about kind of the ETF infrastructure and the create-redeem process, it's a handful of names that's determined by the provider. And so does that cannibalize other parts of the marketplace over time? And if that shuts down, does that have an amplifying, cascading effect across the system? So the truth of the matter is we don't know. It hasn't been tested. We haven't had a credit cycle in a very long time. So there's still a lot of tests that we need to kind of go through. So we shall see.
Okay, Greg, it's always great to have you with us. Thank you so much for coming back on Wall Street Week. That is Greg Peters of PGIM. Coming up, it's not easy these days to be running a legacy media company. We talk with Jon Klein of Hang Media about what's broken and what can be done to fix it. That's next on Wall Street Week on Bloomberg. This is Wall Street Week. I'm David Weston. Media companies have been much in the news recently, and not always in a good way, as both Warner Brothers Discovery and Paramount have taken big write-downs on their linear assets, and prospects for streaming services remain at best uncertain. To take us through the ups and the downs, we welcome back Jon Klein, co-founder of Hang Media and former president of CNN. Jonathan, it's always great to have you with us. But our business, if I can call it that way, the media business, boy, has it changed. But start, for example, with Warner Brothers Discovery, which is really taking it right now. Their stock value is down. They've got a lot of debt, over $40 billion in debt. What do you do there? Is it a problem with the strategy or the execution?
It's a problem with the industry that they find themselves in, is what it is. And this goes way beyond just Warner Brothers Discovery. So, in their case, They've got to swim in the same waters as every legacy media company. They've got a lot of brands. They've got a lot of assets. The main driver of their profit has been the cable TV networks, TNT, TBS, CNN, et cetera. And just the raw amount of revenue available to cable TV-driven businesses has shrunk considerably. The other component of their business, the studio business, same thing, just the pool of money available for them and all of their competitors to make has shrunk. Subscriber fees that the cable distributors are paying have shrunk because viewers have left. So your monthly income on a per subscriber basis has plummeted. And as a result, also, advertising revenues have plummeted. And so, of course, you've got to retrench. You've got to make cuts. They're all doing it. You mentioned Paramount just began their wave of layoffs, their latest wave of layoffs today. And even Axios, which is a digital-only business, they've been through their biggest layoff in the past couple of weeks. So in general, media is really coming to terms with the reality that it's more than ever an industry dominated by the tech giants, the Apples and the Amazons, and certainly Google, which owns YouTube, which is a monster. The industry is dominated by those players, and there's just less opportunity for content creators.
So what do you do in that environment if you're running one of these big media companies? I mean, I think both of our experiences, it's awfully hard to cut yourself to success. You may have to cut, but it's hard to get to success by cutting. Often you then start to think about deals, and John Malone, after all, is the force behind the throne there at Warner Brothers Discovery. Are there deals that could be done, consolidation deals, that might make things better?
Well, you're going to probably look to your left and your right to see who's in the same boat. I think that was their original strategy at Discovery when they did the acquisition of Warner Media, was to get big enough that they can maybe be the biggest kid on the block and dictate the terms of other acquisitions and start doing roll-ups of other players. Now they're not the biggest kid on the block. Now their market cap has taken such a severe hit that the deal numbers themselves are going to be much smaller. But that's what's going to happen is consolidation for all of these guys. You know, you have a new team coming into Paramount, David Ellison and Jeff Shell, who's so sharp. They at least have the benefit of beginner's mind. That is, they can look at that Paramount portfolio of companies in a fresh way, and they also don't have the legacy relationships inside the company, and they can maybe make some tougher decisions. But it's tricky moving forward. Warner Brothers Discovery is going to have to find consolidation partners, merger partners. And just last month in Sun Valley at the big media conference, you know, David Zaslav was bemoaning the excessive government regulation in his mind, you know, that prevents them from making mergers too easily.
So it's one thing to get bigger. People like to get bigger. What about also getting smaller in this respect? Netflix has done pretty well for itself with basically, if I can put it this way, a movie studio hooked onto a streaming service without all those pesky linear channels that you and I have worked with through the year. Is that a strategy? You say, let's double down on the production and the streaming, and let's get rid of the businesses or do something about the business that aren't going anywhere. They're not growing.
Netflix has had the advantage always of being a tech-first company that applied that technology to media content and distribution. At first, just distribution. And now they're in the content business as well. And their market cap is, what, 20 times that of Warner Brothers Discovery at this point? And so they've got that inherent advantage. The problem is that everything we're seeing today is the result of the impact of technology on content distribution, right? We went from cable and broadcast to internet distribution of content. What's about to happen now is the massive disruption of content production thanks to AI. There's just going to be more and more less and less expensive content out there, and the legacy companies cannot really play in that space. You can't turn Warner Brothers into YouTube. YouTube is able to sit there and just allow all their users to post whatever they want. And in the time that we're talking, there are probably going to be 1 million new videos posted to YouTube just in this short time frame. And they can just sit back and present it to everyone. And at the same time, the other power that a YouTube has is all that data collection, all that information about who's posting, what they post, who's watching, what they watch, when they leave, when they come back, so that YouTube possesses this vast trove of audience insight that they can then re-funnel back into their marketing decisions, their programming decisions. What do we buy? Do we buy the NFL Sunday ticket package? Yes, we do, they've decided, right? And now they can analyze behaviors around that as they make other decisions about getting into other aspects of sports rights. And pretty soon, you've got these giants now competing for the same content that's been driving the legacy players for the last several decades: sports, news, right? And now they're taking all that away from the legacy players as well. Their way out of this to a degree, they can supply programming as they resumed doing with some of the HBO programming and all some of the Max programming. They can start to supply others with that programming as well, and just settle into that niche of being a content supplier. But the issue is that the kind of content that younger viewers are consuming in droves is not the fancy studio productions. It's Mr. Beast on YouTube. It's rudimentary, shot on a cell phone, and the audience loves that. And, you know, that's the history of disruption in all businesses. Cheaper, easier, more accessible tends to win the day. It gets a foothold, and then it expands up into more expensive. And so you've got your subscription tiers of YouTube as well, if you want to watch that. But that's how the castle walls collapse around the legacy players.
And Jonathan, as you point out, it's not just what people are watching, it's also knowing exactly who's watching it. It's having the data, and you have the big tech companies have a huge advantage. It's hard for me at least to see how the legacy media companies are going to try to catch up with a Google on the data. But do the legacy companies offer anything to a Google or a Meta or somebody with the data? Do they offer anything that could have some sort of a relationship there that get some of the access to the data and supply something to the big tech companies?
Yeah, they can supply content. They can supply hit shows, which is what fuels all these services. You know, if you're Netflix, you're looking for the next big hit reality series, documentary series, entertainment special, et cetera. So you need content, and you don't want to keep spending at the level that some of these streamers were initially spending at in order to fuel that. So the legacy media companies may become lower cost suppliers of higher end, more polished content. Problem is that with the advent of AI, the tools for creation are going to be available at lower cost to more creators. And so there's going to be a wider pool of potential content for all these streaming services. And Mr. Beast, I cited, he's by far the runaway hit of YouTube, which is the largest network on the planet. And his stuff really doesn't cost that much to produce, and he can churn out a lot of it, and the audience eats it up. So what are you to do if you're a movie studio that's got to spend close to $1 billion to create and launch a Barbie or an Oppenheimer, or the next hit, Mission Impossible? I think the closing ceremonies of the Olympics are a good metaphor for what the legacy companies are faced with, which is you've got to resort to like Tom Cruise jumping off the roof in order to maintain your standing. And, Tom being emblematic of the Paramount Mission Impossible franchise. And that's about the length that they've got to go in order to get us to watch and in a B2B sense to do business with them.
It is a tough business. Jonathan, thank you so much. It's always great to have you here to explain it to us. That is Jonathan Klein of Hang Media. Coming up, the Taxman cometh, this time for Warren Buffett. That's next on Wall Street Week on Bloomberg. Finally, one more thought. Plato taught that when there is an income tax, the just man will pay more and the unjust less on the same amount of income. But however we feel about justice, let's face it, none of us really looks forward to paying the income taxes we owe. And so, when we're in an election season, our candidates go out of their way to promise they'll cut our taxes if only we'll vote for them. Former President Trump touts the tax cuts he got through back in 2017, taxes that by their terms were supposed to go away for individuals next year, but that Mr. Trump promises he'll make permanent if he's elected to another term.
Instead of a Biden tax hike, I'll give you a Trump middle class, upper class, lower class, business class, big tax cut. You're going to have the biggest tax cut. On day one, we will throw out Bidenomics and we will reinstate MAGAnomics.
Mr. Trump's running mate, J.D. Vance, proposes even more tax breaks in the form of a child tax credit he'd take up to $5,000 a year.
J.D. Vance is calling for a higher minimum wage. What is he going to hire Lena Khan next? I'm not sure. Went on Sunday morning television to call for an expanded child tax credit.
This urge to cut our taxes and injected a rare moment of bipartisan agreement into the election when the former president said he'd eliminate taxes on tips paid to service staff.
And remember, what I'm going to do is something that nobody has ever even thought about doing. No tax on tips. For all of you waitresses, for all of you caddies at Doral.
His opponent, Vice President Harris, seconded the motion.
When I am president, we will continue our fight for working families of America, including to raise the minimum wage and eliminate taxes on tips for service and hospitality workers.
Leading Mr. Trump to cry foul because the Democrats have stolen his idea.
But she truly is a radical. She's flip-flopping on everything to get elected. After she gets elected, it all goes right back to where it was.
But let's get back to that justice part of paying our taxes, or at least making sure we're doing our part. It will come as no surprise that we have a deficit problem in the United States, one that puts at risk what our children will inherit from us.
You can't leave your children a negative bequest unless you're doing it through the government. And that's what we're basically doing, is we're leaving our children a negative bequest by running up the debt.
And as much as people like to talk about fixing the deficit through spending cuts alone,
we're already on track to spend more on interest payments than we are for national defense. And regrettably, none of these guys are proposing anything about it.
Most experts tell us that we're going to need someone to pay more taxes someplace if we're to get our fiscal house in order. Which brings us to a possible example of Plato's just man. One of the richest men around, Warren Buffett, has long complained that, if anything, he pays too little in taxes.
Right now, because of loopholes and shelters in the tax code, a quarter of all millionaires pay lower tax rates than millions of middle-class households. Right now, Warren Buffett pays a lower tax rate than his secretary.
This week, we learned that Mr. Buffett has taken concrete action to help us out at least a bit with our national deficit. When he sold off a good portion of Berkshire Hathaway's stake in Apple, he ran up a tax bill of some $15 billion. Now, that may seem like a high price to pay for a shrewd investment, but as Doug Kahn, my baby tax professor back at Michigan, baby tax is what we call tax one as opposed to the much more difficult corporate tax course. As Doug taught us all those years ago, the good news about paying income taxes is that they're always less than the money you made. And in the case of Warren Buffett, he owes that $15 billion on a nice gain of $59 billion. And maybe it will relieve a bit of the tax burden on those less able to afford it.
Mrs. Gilmore owes the IRS $270,000. We're going to have to sell the house to someone else.
But she's an old lady. I mean, look at her. She's old.
That does it for this episode of Wall Street Week. I'm David Weston. This is Bloomberg. See you next week.